Where are the existing inefficiencies sort of broadly in crypto right now?
Is the FTX blow up fraud or just bad luck? During my research to find the truth, I found a podcast from about 6 months ago. It was the Bloomberg podcast Odd Lots. The podcasters invited Sam Bankman-Fried to talk about the state of the crypto industry in 2022. The description of the podcast says, the price of major cryptocurrencies like Bitcoin and Ethereum have been moving sideways for a while. But it doesn't seem like there's any slowdown in terms of money entering the space. Every day, some new fund is being launched or some legacy financial institution is diving into it. But what's all this money going to do? On this episode, we speak with Sam Bankman-Fried, the CEO and co-founder of FTX, as well as Bloomberg opinion columnist Matt Levin, the money-making opportunities that people are exploiting, whether it's, and here comes, directional bets on coins, or yield farming, or arbitrage, and how much potential profit there is for the taking. And I learned in my life that whenever I hear arbitrage, the alarm bells should ring. The second thing that I didn't really understand in the description was, what is yield farming? We will find out. Here is the clip from the podcast episode. It starts relatively harmless here, but listen.
Yeah, I mean, they're a little all over the place, although obviously way smaller. In particular, I think it's a lot less, well, you buy on this exchange, you sell on that exchange. As you said, it's a lot less identifiable in some senses what it is. So what is it if it's not that? Some of this is just traditional HFT stuff. There's $150 billion a day of volume that it's trading on a bunch of different order books. And when you say how efficient is it, right? Like how mispriced might these order books be? Well, I don't know, take 2 Bitcoin or Bitcoin futures order books right now. They probably each have fees of a couple basis points and a spread of a basis point or, some fraction of basis point or something like that. And given sort of like the funding rates and the premiums of futures and things like that, and the time and cost to do one of these ARBs, they can absolutely be a few bips, out of line with each other. And so in theory, you can sort of do out the math. Let's say that, you made 1 basis point on each side, which would be a lot and would be like, an impressive amount to make on the serve volume on 50% of volume in crypto. Taking the extreme of like you were the arbitrager, you're the HFT firm, then how much is that a day? Well, a BIP on $50 billion of volume is $5 million of profit a day, which is $1.5 billion a year. And so that gets some sense for, and again, obviously I'm sort of like cutting a lot of corners in that. Like I don't want to sort of imply that that's like that is the amount that could be made, but whatever, maybe that gives some sense for like what the available scale here is of arbitrage profit in the space. It is like substantial. And so that's part of what they're doing. What other things are there? Well, farming is actually probably.
So far, so good. He explains a little bit arbitraging and who doesn't love to do that. But here it comes. Now listen.
I hesitate to say that it's been the biggest source.
I'm glad you brought in farming,
but it might be. I wouldn't be shocked if you added up all the sophisticated firms together and said, like, over the last couple of years, have they made more from farming or trading? The answer might be farming.
Can you give me an intuitive understanding of farming? I mean, like, to me, farming is like you sell some structured puts and collect premium, but perhaps there's a more sophisticated understanding than that.
What is yield farming all about? And he explains it very clearly in the next few minutes.
Let me give you sort of like a toy model of it, which I actually think has a surprising amount of legitimacy for what farming could mean. Where do you start? You start with a company that builds a box.
We start with a company who built a box. A box basically are cryptocurrencies. So listen closely what a box in the crypto world is.
And in practice, this box, they probably dress it up to look like a life-changing, world-altering protocol that's going to replace all the big banks in 38 days or whatever. Maybe for now, actually ignore what it does or pretend it does literally nothing. It's just a box.
Okay. So the builders of the box pretend that they can replace the banking system in 38 days, but it doesn't really matter. It's just a box, nothing more, nothing less. Good to know now that the crypto market has crashed.
So what this protocol is, it's called Protocol X. It's a box, and you can take a token, you can take Ethereum, you can put it in the box, and you can take it out of the box. Like you put it into the box, and you get like, an IOU for having put it in the box, and then you can redeem that IOU back out for the token.
You have a box, you can put money into the box, you can take money out of the box. Let's continue listening.
So far what we've described is the world's dumbest ETF or ADR or something like that. It doesn't do anything, but let you put things in it if you so chose. And then this protocol issues a token. We'll call it whatever, X token. And X token promises that anything cool that happens because of this box is going to ultimately be usable by, governance vote of holders of the X tokens. They can vote on what to do with any proceeds or other cool things that happen from this box. And of course, so far we haven't exactly given a compelling reason for why there ever would be any proceeds from this box. But I don't know, maybe there will be. So that's sort of where you start. And then you say, all right, well, you got this box and you got X token. And the box protocol declares or maybe votes via on-chain governance or something like that what they're going to do is they are going to take half of all the X tokens that will have reminted, maybe 2/3 though, 2/3 of all ever X tokens, and they're going to give them away for free to everyone who uses the box. So anyone who goes, takes some money, puts it in the box, each day they're going to airdrop 1% of the X tokens pro rata amongst everyone who's put money in the box. That's for now what X token does. It gets given away to the box people. And now what happens? Well, X token has some market cap, right? It's probably not zero. Let's say it's $20 million market cap.
Okay, so let's sum the last few minutes up. Basically, box people put money in the box. The box issues a token. There is no use case. It simply does nothing, and magically it has some value for nothing.
And a bunch of arbitrators
come from like first principles, it should be zero, but okay.
Sure. Okay. I completely reasonable comment.
That's not quite true, but it when you describe it in this totally cynical way, it sounds like it should be zero. But go on.
Describe it this way. You might think, for instance, that in 5 minutes with an internet connection, you could create such a box and such a token, and that it should reflect it should be worth $180 or something market cap for that, that effort that you put into it. In the world that we're in, if you do this, everyone's going to be like, ooh, box token. Maybe it's cool. If you buy a box token, that's going to appear on Twitter and it'll have a $20 million market cap.
In first principles, it should have a value of zero, but for some people it has value. But in principle, it does nothing. Let's continue listening. It will get much better.
And of course, one thing that you could do is you could make the float very low and whatever. Maybe there haven't been $20 million that have flowed into it yet. Maybe that's sort of is it's mark to market, fully diluted valuation or something. But I acknowledge that it's not totally clear that this thing should have market cap. But empirically, I claim it would have market cap.
I agree.
It shouldn't have any market cap in theory, but in practice they always do. Okay.
That's right. So, and obviously already we're sort of hiding some of the magic in that, right? Some of the magic is in how do you get that market cap to start with, but whatever. We're going to move on from that for a second. So, X tokens being given out each day. All these sophisticated firms are that's interesting. If the total amount of money in the box is $100 million, then it's going to yield $16 million this year in X tokens being given out for it. That's a 16% return. That's pretty good. We'll put a little bit more in, right? And maybe that happens until there are $200 million in the box. So, sophisticated traders and or people on crypto Twitter or other sort of similar parties go and put $200 million in the box collectively, and they start getting these X tokens for it, right? And now all of a sudden everyone's like, wow, people just decide to put $200 million in the box. This is a pretty cool box, right? Like this is a valuable box.
So because some money put people in a box and issue some token, other people think it's a cool box and put more money in the box. What is this all about? I think people who are a little bit longer in the investment world think about one term probably right now and continue listening.
As demonstrated by all the money that people have apparently decided should be in the box. And who are we to say that they're wrong about that? Like, this is, I mean, boxes can be great. Look, I love boxes as much as the next guy, right? And so
I couldn't agree more. Who doesn't love boxes? And the podcasters start laughing. Here it comes.
What happens now? All of a sudden, people are kind of recalibrating. It's like, well, $20 million, that's it? Like that market cap for this box, and it's been like 48 hours, and it already has $200 million, including from like sophisticated players in it. They're like, come on, that's too low, right? Like, and they look at these ratios. TVL, total value locked in the box, as a ratio to market cap of the box's token. And they're like, 10x, that's insane. 1x is the norm. And so then, X token price goes way up, and now it's a $130 million market cap token because of, the bullishness of people's usage of the box. And now all of a sudden, of course, the smart money, it's like, oh, wow, like this thing's now yielding like 60% a year in X tokens. Of course, I'll take my 60% yield, right? So they pour another $300 million in the box, and you get a cycle, and then it goes to infinity, and then everyone makes money.
So in principle, the podcasters clearly call him out.
I think of myself as like a fairly cynical person, and that was so much more cynical than how I would have described farming. Like, you're just like, well, I'm in the Ponzi business, and it's
Ponzi schemes. So this is, most cryptocurrencies are pretty much just Ponzi schemes without any economic value, without any use case behind it. It's just boxes where people put money in and hoping that more people come who put more money in, so that the value goes up until we reach the last back holders who will lose all their money.
Pretty good.
At no point did any of this require any sort of like economic case. It's just like other people put money in the box, and so I'm going to too, and then it's more valuable, so I'm going to put more money in. And at no point in the cycle did it seem to like describe any sort of like economic purpose.
So on the one hand, I think that's a pretty reasonable response, but let me play around with this a little bit, right?
If you want to continue listening to this podcast, you find the link in the description below. It's really awesome. I think there is much regulation needed in the crypto world right now. I hope it comes. Enjoy your day.